I adjusted the audio setting on the last video, so I hope that it was better, because I gotta be honest, I don't sit down and re-listen to hour and a half video, whatever it is. I just make some notes in the now if I don't think anything's any good, and then I can just edit it and cut it out. But so I haven't listened back to all of it. The bits I did listen to, I feel like it was better than what it was before. I've adjusted it again slightly since then, so hopefully we'll see how it is, and if anyone doesn't like it, then hopefully they'll comment and tell me, but hopefully it's better than it was. Monitoring the mix a bit more on this OBS thing as well, than I was previously, and it seems to be doing okay, so we'll just see how it goes. Right, for any of you that don't know, get a disclaimer out of the way to start with, although there's one on the intro to the video anyway, which you should be reading, by the way. But I don't know what I'm doing. I have no financial background. I hold no financial qualifications. All this channel is me vlogging my educational journey towards hopefully becoming a successful investor. So this video is for informational purposes only and does not constitute investment advice. Any opinions formed during this video are my own and not recommendations, and are subject to change without notice. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions. So got that out of the way. Now we'll just crack on with it. I know I finished the last video, which I don't think has gone up yet when I'm recording this. I don't think it's actually been uploaded yet. Tomorrow morning possibly. But I finished that one saying that I would look at a certain company. So well, there it is there. So we'll get down to it, I would imagine, in this video. Just noticed this though. I refreshed the screen, it was being a bit slow, so I refreshed it and then I had to resort it by, I tend to sort it EV to free cash flow, lowest multiple, then going down. So Bumble's been something I've been looking at for ages. I think I even did a video on it reasonably recently, because it started taking off again. It's one thing that I can't make my mind up on, but just noticed it appears to have crashed back down again, so I was just going to see why. Bumble stock trades up. Does it? From there to there, I take it. I don't know. This is like a lot of this stuff here is crap noise, effectively, because oh yeah, it's traded up today. Like, no, we're looking for serious gains, you know what I mean? My goal, if I can become a successful investor, is to hopefully try and beat the market. So when you're reading stuff like this, where it's obviously wrote for people to monitor it day by day by day, I'm sorry, but if you're maybe watching for that, this channel, not that I'm going to say no to your views because I need them, but this channel's probably not for you. This is more long term. I'm looking for investments, you know, not day trades or anything like that. I do a little bit of technical analysis, I will say. That is where I started in the investment game, thinking that there was a shortcut to it, but once I started reading like Warren Buffett stuff about Michael Burry and Joel Greenblatt, Monish Pabrai I'm big into, and Lee Lu, but there's not a lot out there on Lee Lu. Once you start reading stuff like that, you're thinking, what the fuck is this technical analysis stuff? Not that I'm saying that it's hoodoo, because I definitely think it has its uses, and it's almost like a self-fulfilling prophecy sometimes if enough people's interested in it. But it's not for me, and it's not what moves my analysis at all. I might use it to help me with some entry points or exit points maybe, but it's not for me. So when you're getting stuff saying, oh yeah, it's moved, then you go trade it up today, like I don't care today. I want to know what's gonna, you know, I want a trade that's gonna be 50% in a year, you know what I mean? So what I was actually going to look at was the last time that I looked at Bumble. Go back to the weekly. I'm almost always on the weekly because that's what my time frame is longer term, you know. Last time I was looking at this, it was actually higher. Be interesting actually. After poo-pooing technical analysis, right? It'd be interesting to see here. It if this holds, then it might be a potential for a buy, but that's not financial advice, by the way. But from a technical perspective, that's what they would be looking at, double bottom and gone. But I just want to know why it's plummeted. Look, this is what I mean though about the craziness of it. 2 days ago, Bumble's trading up. Here's why. Yesterday, Bumble shares plummet. What you need to know, like ludicrous. Number of stocks fell in the morning session after strong payroll print. Oh, because of jobs. Consumer subscription company Bumble fell 3.4%. It's now the time to buy Bumble. Okay, I didn't know they do. Bumble shares are extremely volatile and have 34 moves, creating 5% over the last year. In that context, today's move indicates the markets consider this news meaningful, but not something that would fundamentally change its perception of the business. I thought the Bumble was a reasonable business. I feel like it had debt, but it also had a lot of cash flows, and everybody is valuing it on its subscriber base, which I understand, right? Because the more subscribers, the more advertising revenue. But it's almost like it was being priced to like it's not going to be around, and I don't know. I haven't been on dating apps for years. I got a partner and we're very happy, and our family's very happy. So I haven't had a need to be on these for years, but I always thought the Bumble was a popular one back when I was on them. Doesn't seem to be the case anymore. I'm guessing, I don't know. It's down 21% beginning of the year. It's trading 60 below its 52-week high. Okay, so hang on. New feature being tested in New York allowed users to pay a fee to join small in-person gatherings. This initiative aimed to transform online connections into real-world meetings while creating a new source of income for the dating app. The move came as Bumble looked for ways to attract users back following a period of decline in revenue and paying subscribers. Stock rise also occurred on the day of the company's annual stock meeting. So basically, they don't really know. Is that what they're saying? Considers this news meaningful, but not something that would fundamentally change its perception of the business. Do we read their report? It's free. I gotta be honest, I don't tend to try and read a lot of other people's reports. I come to my opinion and then I don't want to be like swayed by somebody else's, but then also, I'm not fucking logging in here. Alright. Also, it is valuable though, because I try to read stuff that's got an opposite opinion of mine if I do read stuff. Hopefully they open my eyes to something as opposed to reading something that give you confirmation bias, Anyway, what is this? ZoomInfo Technologies Inc. is a holding company which engages in the provision of cloud-based platform. So no tangible book, no asset-based downside protection, but there won't be because it's a technology firm. Very rare that they do have them. What's going on here then? Oh, it's not got enough data long term. 1, 2, 3. Simple free cash flow though. Enterprise value of 900, so-called simple free cash flow of 375. And yet the stock price looks like shit, so breach it. Oh, hang on then. Something's going on, isn't it? Something nasty's going on. Insiders breach their fiduciary duties to shareholders. Has there been, before we read that then, has there been, what was it, GTM? Some insider buys or sales? There's one there, 27,000. Oh, it's very difficult to tell the difference between the colours there, isn't it? There's a buy there for 5 million in 2024, a much higher share price than now. So the CEO's not done very well out of it, has he? If he is still even the CEO. Right, what have they done? Let's read this. To contact the firm, discuss their rights and options at no cost or obligation. An investor rights law firm is investigating whether certain officers and directors of ZoomInfo Technologies breached their fiduciary duties to shareholders. Oh, fucking hell, I'm yawning already. That doesn't bode well for this video, I'm afraid. If you currently own ZoomInfo stock and are a long-term shareholder, you may be able to seek corporate governance reforms, return of funds back to a company, a court-approved financial incentive award. Okay, but why? Doesn't say. Okay. Anybody else talking about that? 12-month target implies 47% outside. So, asks you a question and gives you no information on it. Let's get this is the one I wanted to get to, so we will get to it eventually. SEC, what am I looking for? GTM. No, what's going on there? Am I spelling this wrong now? Yeah, I am. That's the only thing. I put a search engine in, which I got from one of Roaring Kit's videos actually. What's it called? Zoom Industries. Zoom Technologies, GTM, there it is. Why didn't I find it? But sometimes if you forget and you don't get your search engine shortcut correct, it don't like it. Right, what are we looking at? Balance sheet, always with a balance sheet. Let's try and find out what the business does first. Come on. I need to start going back to doing stuff in a logical manner. Just copy and paste this one a minute. This is a question that I generally always start with. I need to tell you what I need to do. Copy and paste it into a Word document I've always got open beside on a different screen. GTM. What's it called? ZoomInfo Technologies. Right, let's see what it does. If you're watching this for the first time, I use quite a lot of AI to try and help me out. I found it is quite a good tool for getting information on things like this. It can also be a teaching tool, but sometimes I don't know whether or not what it's teaching is correct, so just be very warned on that. It's a leading provider of all-in-one AI-powered go-to-market intelligence platform. B2B data, insights, intent signals. Okay. Go-to-market. Strategies, process, and tactics that companies use to bring product services to market align. It's heavily branded around this. It positions itself as number one go-to-market platform or AI platform. Okay. Operates a primarily subscription-based SaaS. Oh, I always forget what SaaS means, and then when I Google it, I feel like an idiot. Software as a service. Right. Core offering, cloud-based platform providing access to B2B intelligence, AI tools. Right, hang on then. Revenue mix, vast majority subscription, 98%. Wow. Diversified across industries. Growth levers, models, high gross margin software data with investments in data quality AI. Okay, revenue breakdown, overall scale 1.25 billion in GAAP revenue. ZoomInfo reports revenue primarily disaggregated by service type rather than. So where's this from? Q1. Right. Heavily US centric, 80 to 90%. So I still don't understand what the business does. So what we can do now, look. Government data provided a comprehensive AI GTM operating system. Recent priorities, right. So what we can do now, I still don't understand what they actually do. Explain simply end to end what a customer would go to them for and what GTM would do for them. fort them. This is the thing I like about AI, is that I definitely agree with Warren Buffett and Mohnish Pabrai in that if something's too hard and you don't understand it, move on. But AI is definitely has the potential to help you understand something better and faster, especially if it can explain it to you in simple terms. So we'll see whether or not this one does. But yeah, simple explanation. It helps companies find the right potential customers, understands when they're ready to buy, reach them effectively, and close deals faster. Typical customer signs up because their sales and marketing team struggles to find accurate contact info for decision makers, wasting time on cold call outreach to people who aren't interested, not knowing which accounts are hot right now, fragmented tools. Right. They want one reliable system to go to, end-to-end what a customer does. Here's a straightforward flow a sales or marketing team might follow. Define who to target. You tell the platform, show me mid-size SaaS companies in North America that use certain technology, have recently hired a new CTO and are growing. Combine ZoomInfo's massive database, 100 million plus companies, 500 million plus contacts, with your own CRM data. What's CRM mean? Fuck CRM. Google. Customer relationship management, is that right? Is technology and strategy the business CRM system as a centralized single source of truth? Access unified data in one place, okay. It enriches lists, firmographics, company size, industry revenue, binds signals and prioritize. The platform scans billions of signals daily, job posting, earnings calls, news websites to spot intent. It flags accounts that are in market, actively researching solutions like yours. AI scores and ranks them so your team focuses on the hottest prospects first, not spray and pray outreach. You get verified emails, phone numbers, direct and buyer personas for the right people inside those companies, not just generic. Shows buying committee details and recent context. So, sales reps use GTM Workspace and Copilot for next best actions, personalized email drafts, call scripts, marketing builds and launches, multi-channel campaigns, workflows automate when a target company shows intent, trigger personalized outreach, notify the rep. Everything syncs back to your CRM. You see engagement. AI agents can even handle parts. A customer might go from, we have a vague list of 10,000 companies, no idea who to call. Here's a prioritized list of 200 hot accounts with accurate contacts who why they're interested now. I'm ready to send personalized messages. It unifies a bunch of separate tools. The goal is higher win rates, less wasted effort. It's especially valuable to B2B companies selling to other businesses where deals are complex and involve more. Yeah, but okay, but I still don't understand. To be honest, the fact that I'm writing still don't understand probably means you should walk away from it. I still don't understand what they are connecting and why. Connecting customers to buyers of what? Can it be anything? Companies that sell products or services to other businesses include software companies, consulting firms, manufacturers, buyers, other companies that might need what the sellers are offering. It does not sell customer products or connect to individual consumers. It operates entirely in a business-to-business world. Selling businesses is hard because deals involve multiple decision makers. You need accurate contact details. Timing is critical. It acts as a middle layer that makes this connection efficient and target. If seller signs up, they search and build a list of ideal buyers. Wanting more, okay, software company wanting more customers. They find companies that match their criteria. They get contact details and context verified. They see buying signals to flag which companies are actively researching solutions. They engage smarter. AI tools. Instead of cold calling random companies or buying bad lists, the seller team focuses Okay, real world example. Payroll software company uses ZoomInfo to find mid-sized manufacturing firms that recently posted jobs for HR management using all payroll system, are showing intent signals around payroll, gives them the decision-making contact plus context. The sales team reaches out with relevant message, higher chance of meeting sales. In short, ZoomInfo helps companies that sell to businesses find, understand, and connect the right other businesses and people inside them who are likely to buy their products or services. There you go. It's sales marketing intelligence. That makes more sense. Okay, like I said, eventually you can get it to explain the business to you. It just depends how stupid you are, like me, and how deep you need to keep asking for them to do it. Okay, so current assets. 172 million in cash. What's the total liability? Is it? Oh fuck, they got some debt. Tax receivable agreements, that's huge. Long-term debt net of current portion. Core. Basically close to 2 billion in goodwill and intangibles. I don't like that, although goodwill year on year has actually stayed the same. Intangibles have dropped, so there must have been some sort of write down. What do I think of this then? We're going to say 4.3 billion in total assets, and then there's only 4.9 billion in total liabilities. Because goodwill ain't worth fucking nothing, is it? Not really. Not unless you've ended up buying like Formula One or Ferrari or something like that. Even then, the intangibles is worth more than the goodwill generally. A huge liability there. Let's see what that is. We'll ask in a second. Go to the income first. Cost of service. Right, cost of revenue. Or revenue, 310 million. Gross profit, okay. Quite a high gross margin then. Sales and marketing, amortization of other acquired intangibles. Yeah, so they got write-downs. Total expenses. Net income, 57, so it's gone up. Gone up by 7 million when revenue's only gone up by 5, so that's pretty good. Net income, $29 a share. Right. Cash flow statement. Lower. Equity based compensation expense. What's that? Stock comp. Yeah, share based payments. Don't like that, but there we go. It's quite high as well, really. Close to a quarter. Accounts receivable. Accounts payable. Unearned revenue. Okay, so it doesn't look like there's anything nuts there, does it? Asset impairment. Okay, let's ask about the balance sheet then. Is this Q1, by the way? Yeah, it is. Might have to get a 10k up, see what happened last year. Balance sheet. In their balance sheet, we need to see what the debt schedule is like as well. In their balance sheet, they have a large liability for, where was it? Tax receivable. Oops. Tax receivable. Let's try and spell properly. We've moved the microphone out of the way of the keyboard now. I can see what I'm typing and still get it wrong. Liability for tax receivable. Where was it again? Can't see it. Agreements. Explain this. I could be wasting one of my questions. Like if I click on this. Nope, doesn't say. Okay. Roughly 2.73 billion is a common feature of many IPO structures. It's not a traditional debt to a bank or vendor, but a long-term contractual obligation to share future tax savings with pre-IPO owners. Went public in 2020 using an Up-C. What's an Up-C? What is an Up-C? Umbrella partnership is a popular tax-efficient financial framework used for private partnerships or LLCs to go public. It allows pre-IPO owners to take their company to the stock market while keeping the business's original pass-through tax status and enjoying significant personal tax benefits. A uniform parent holding company goes public and lists economic shares on an exchange. The original business entity explains simply how it works. We're going across two different AI fucking things now. Explain simply how it works, and the tax liability it forms. Works like an apartment building where the public and the original founders live on different floors, allowing founders to avoid double taxation while still controlling the company. Imagine your original business is an LLC. To go public, you build a new top floor. Public investors buy shares here. The pubco takes the investors' cash and buys a piece of the bottom floor. The bottom floor, the original business keeps running here. The founders keep their ownership units down here. Founders get special voting-only shares in the top floor so they can still run the company. When founders want cash, they walk across a bridge, swap the bottom floor units for top floor public shares and sell them on the stock market. I'm sure to the AI that sounds simpler than, well, that is simpler than it sounds. Pass-through entity profits flow straight to the founder's personal tax returns. They avoid 21% corporation tax on their share of income, pay standard corporate income taxes on its share of profits when it pays dividends to public shareholders. Biggest tax event happens when a founder decides to use the bridge to sell shares. When a founder exits, Pubco gets to revalue its piece of the business to current market value, massive corporate tax deduction called a tax basis step up. Because the founder's exit created this corporate tax saving, the contracted tax forces Pubco to sign over 85% of his tax savings back to the founder. This creates a long-term financial liability on the Pubco's balance sheet. Okay. This is all very complicated, isn't it? The founder owns 100,000 units in the underlying business. The original cost base is $10 per share. The company goes public and the share price hits $100 per share. The founder decides to exchange all 100,000 units for public shares to cash out. The exchange of units for the company triggers an immediate capital gains tax for the founder. Market value of shares, less original basis. So 9 million taxable. Founder's tax bill, 20%, 1.8 billion. Founder keeps 8.2 million after personal taxes. Because the founder just sold the units to the public corporation. Wait, who are they selling it to? It gets to update tax value of those assets from 10 to 100. These $90 per share. Pubco can use this 9 million step up as a massive tax deduction to reduce its shield to future corporate income. Public corporation must save in actual cash on its future tax bill, splitting the tax. Under the mandatory tax agreement, the public corporation cannot keep all of that cash. It must pay 85% of those ongoing tax savings back to the founder as extra cash bonuses, creating a formal liability on its balance sheet. They successfully sold their business for $10 million while they paid $1.8 million in personal capital gains. They eventually claw back $1.6 million in cash payments directly from the public corporation over time through the TRA. This effectively neutralizes a massive portion of their equity. Corporation gets a 283 tax windfall wouldn't have had in a standard IPO structure. The company must carry a liability. So, God, it is real then. Is there a time limit on this then? On this liability. No standard regular time limit, but there's a structural timeline dictated by tax laws. 15 to 20 years. Okay, now. That's complicated, isn't it? Mostly long term with small. Significant intangible assets and goodwill from its history and acquisitions. Tax basis step up on these creates large ongoing. Honestly, it's probably getting too complicated for me. Essentially, royalty-like obligation on future tax savings, but requires sharing most of the cash benefit of former owners over a long period. Does not mean that ZoomInfo owes tomorrow. Payments are spread out and contingent on actually realising the tax savings. What is a typical time scale for this liability to become current? That's what I'm trying to figure out. You might have some decent cash flows, but on a rolling year-by-year basis, actually realises the associated tax savings. No fixed maturity schedule like traditional debt. Instead, classification depends on management's estimates of when tax benefits will be realised. Payments are generally annual. Most of the liability remains long-term, no current for many years. Current portion is usually small. Span 15 plus years. The company really measures the full liability periodically. Current portion often near zero. The pattern has held for years of actual cash payments made. So, this liability is very real, but is it a problem? It's not currently a major operational liquidity problem. It's a known structure feature of actual tax savings. ZoomInfo only pays when it realises real tax benefits. Taxable income is low or losses offset deduction payments are reduced or deferred. Current portion is tiny. The amount expected to be paid within 12 months is usually near zero. Strong cash flow covers it comfortably. Actively repurchase shares. Okay. Payments could exceed actual tax benefits in some scenarios. In a change of control, payments can accelerate dramatically. Companies hold income. TRA is a large balance sheet liability. It reduces reported GAAP net income via remeasurements and will require cash outflows over 10 to 20 plus years. However, it's manageable given the company's cash generation. It is more of a long-term cash allocation item like a contingent royalty than an imminent threat. Most investors treat it as a known structural feature rather than a red flag. Okay. It seems complicated, doesn't it, to me? Let's see what's going on with the cash flows. I think we had a look, didn't we? And nothing was crazy. Let's get the 10k up. While we are here, let's have a look at the level of insider ownership. Oh. Where's the list? They not got a list. Where's the insider ownership list then? Ownership of securities, is it this one? Yes, it is. Why did I not find beneficial? Maybe I spelled beneficial wrong, did I? 9.9%. Directors and executive offer a group 13 persons, 9.9%. Almost all of it is Henry L. Schuck, whoever he is, number 9. Who is Henry L. Schuck? Isn't there a list of the people at the top? Where are they? Oh shucks, CEO. Okay. Right. Where were we? 10k. We spent a lot of time on this actually. Maybe managed to rise right. If you don't understand after like 2 questions, leave it. Cash flows. DNA. Amortization of deferred commissions costs. Amount expense reorganised in the current period for the periodic realisation of capitalised fees that were paid to salespeople. Okay. Asset impairments. Equity place 100 million. Fucking hell. A quarter. I don't like that. So we've got 300 million in free cash flow. Purchase of property, plant and equipment, 76 million. It's gone up. Look, are they expanding maybe? So what was it? 350 million minus 80, 270 million free cash flow. 270 million divided by 300, so under 270 divided by 305. 89 cents a share in free cash flow. What is the enterprise value? 900 million. Alright, let's just put it into the big spreadsheet quickly. The quick data spreadsheet is not my main spreadsheet, by the way. It's whether it gives me a few quick metrics that I'll look at to see whether or not I should be interested in looking at something deeper. GTM. Unfortunately, it is not like Roaring Kitty's. Well, it is very much like Roaring Kitty's spreadsheet. Actually, it's based on his, but it's nowhere near as complicated because I can't just drag stuff in like he does. It's copy and paste it like a loser. Billion. I've got the enterprise value and 315 million in free cash flow. Gross margin 84%, very consistent. It's actually grown as well. Look. Book value shrinking though. Current ratio is not good. Interest coverage is very good though. What's current liabilities? Total current liabilities 600 million. How much cash have they got? 171 million. And they've made, so they haven't got enough money. So they've got a liquidity crisis potentially. Do they have a near-term liquidity problem with current liabs at, what does it say they were? Let's see if my data is correct. 600 million. Not enough cash or free cash flow. With not enough cash or free cash flow to cover. I shouldn't need to ask, just so I can see that they've got a problem. It's not a near-term liquidity problem. Looks larger on paper as manageable given the company's cash generation. Unearned revenue, deferred revenue, largest item by far, so it's not a cash outflow. Yeah. I was reading it wrong. That's because the data is not really broken down enough, is it, in the spreadsheet? Yeah, so it's not broken down enough. Oh, it is deferred revenue. I didn't see it. Should have looked harder. Okay, yeah, I'm not so bothered about that. Yeah, because of the unearned revenue. So basically they just got to do the work. Non-cash deferred revenue, not pressing payables or maturing debt. Sufficient liquidity, no near-term liquidity. Yeah. I just read that wrong. So that's on me. What else are we looking at then? So I don't need to worry about this so much. Revenues 389 a share. Enterprise value is 322. Simple free cash flow shares 98. Very consistent the last few years. With a reasonably consistent free cash flow margin as well. So why is it not doing so well? What have they forecasted? What have GTM forecast for revenues? Because this has been probably 50%. It's could be relatively interesting, this, couldn't it? Decline of approximately 4% year over year. The company lowered guidance due to a challenging macro environment, AI-related buyer hesitation, especially in software. Okay, context. Beat the high end of the prior guidance. Net revenue stable 90%. The company is in transitional period, emphasizing enterprise upmarket customers and a hybrid pricing model, moving away from pure seat-based towards consumption-based. This is causing short-term revenue pressure. These forecasts reflect the management conservative stance amid uncertainty. Operating income, net income, dollar. Even then, if that is correct, it's 3 times earnings. Explain the change in pricing model that is causing pressure. That's what you said, it was causing pressure, so let's ask. I know this isn't the most recent one, this is 10K, but right. Oh dear, sorry, punched the microphone again. Shifting from a predominantly seat-based subscription pricing model to a hybrid consumption-based model. Customers pay primarily based on the number of users, seats. This e.g. sales reps or marketeers accessing the platform. This included fixed annual platform subscription fees tied to seats, provide a predictable, rateable revenue recognition in ZoomInfo, but created issues. Customers reduced the number of seats during renewals, especially in tough macro. Didn't always align perfectly with the actual value of data consumption. New hybrid consumption structure, low fixed annual platform fee plus pre-purchase. The customers pay upfront for a pool of credits. Credits are consumed based on actual usage rather than tied to strictly head count. Better aligned pricing with customers' value and AI driven. Existing customers are being moved often from fixed seat-based contracts to new models. Some results in lower spend, others higher, but the net effect in the short term is negative or flat. Negative, okay. Consumption negative is what you've got to see there, even if it's, not a huge deal. Value investor always got to look at the downside. Revenue recognition change. Consumption models introduce more variability. This can delay or smooth revenue compared to steady monthly seat fees. In a cautious macro AI uncertainty environment, buyers are hesitant, leading to longer sales cycles, more scrutiny, and some seat reductions. The company is targeting a shift from 2 to 3 seat-based ACV. I don't know what ACV means. 50-50 within. Okay, management has explicitly called this out as creating a near-term headwind reflected in the guidance, but they believe it will lead to higher long-term retention and expansion, larger total addressable market. This is a strategic bet to modernize the business and reduce seat compression risks, similar to shifts in companies pairing this with cost cuts, e.g. 20% workforce reduction. Wow. Oof. Okay, what was their revenues again? What did they say the revenues was going to be? 1.1 billion. Oh dear. Oh dear, what do we do here then? This is very consistent. 1.1 billion, let's go to a billion. Future revenues, where is it? There. A billion. They got no tangible assets, so this calculation is not going to work out. I'm happy to use much higher than that because it's very consistent around not 800%. Oh, fuck off. What have we done there? Messing up majorly, am I? Alright, what did I do there? This. I wanted this. 15. Yeah. What was it historically traded at then? Very difficult to tell because it's quite a new business. Price to free cash flow. 4. 8 to 10. 16. It came out. Fucking hell. I mean, this is just a guess. What would you pay for this? 5 times, maybe. I don't know. 20% simple free cash flow margin. Say 8. 5-year business. 800. So it's trading at a billion now. 1.2. It doesn't give much upside, does it? Joel Greenblatts one on a multiple basis. 6 times free cash flow. I mean, you're still buying the company back within 6 years. Six times multiple. Most for buys 1, 4. What is it currently? 2. Potential 50%. I don't know. At the moment, it's 3 times earnings. What's the debt schedule? We need to look at the debt. We need to look at the debt. Let's open up the actual 10Q. Let's figure out what's going on with the debt. Leases. Financing arrangements. Long-term debt 1.3 billion. Senior debt notes 645 million. Maturity date 2029, 2028, 2030. Okay. Has it actually got traded debt? What has happened here? There we go. GTM. Microphone's a bit too low. Hang on. Right. Nothing. Zoom. Show. ZoomInfo. Here we go. There's 3 of them. What are they trading at? Where's the bar across the bottom? Oof. Not bad, but considering only 3 years out, is it because there's better yields out there? 3 is probably quite low for this market. I don't know. 13% yield. Have they got a dividend? Have they got a dividend? Not by the look of it. Okay, so no dividend. No dividend. What's the share count done? Down, down, down. Are retiring or holding the shares. I don't like the share-based compensation. I think that's fucking ludicrous. It's really high. But my simple free cash flow is after share-based compensation. I'll remove it. At what point does it get cheap? So they've got, what's the next one? 2028, 100 million 2028. They can afford that. It's a revolving credit facility as well, so they could just refinance that. The senior notes, 3 years, they could probably make enough to cover that. Interest expense, what's interest coverage? 7, 6, 7. It's very good the entire time. So even if they couldn't pay it off, they can probably refinance. At least with the way things currently are. It's how that is going to, the new pricing model is going to affect it. There you go. They're normally trading around about average of 10 times. Forget those, that's ridiculous. 10 times. It's currently at 3. Return on capital is not great. 7%. That's not great business. Simple free cash flow is good though. 84% gross margin. Why is return on capital so low? Using Joel Greenblatts calculation. Goodwill and intangibles, next that's cash from denominator. This often produces higher ROC numbers for asset-like businesses, but it's not. Primary reason is massive goodwill and intangible assets on the balance sheet. Formula tries to strip these out for a tangible view, but even then the company's high historical acquisition premium is utilised intangibles. EBIT is also compressed due to high amortization. Even with strong gross margins, 80% adjusted operating margins, and excellent cash conversion, the denominator is large relative to the operating earnings. This makes ROC look poor compared to class. Asset light should theoretically support high Greenblatt, however the accounting goodwill from growth via acquisition structure overrides this. High deferred revenue actually reduces net working capital in the formula, which helps ROC but not enough to offset the overall capital base. Some sources show much higher because the formula aggressively excludes intangibles. Reflects ZoomInfo acquisition heavy history and large balance sheet intangibles, not poor underlying operations. The business is highly cash generative and asset light in reality, but accounting distorts the metric. This is common in software tech companies that grew via mergers and acquisition beyond a single number for competitive moats. Strong data moat and switching costs. So the most accurate custom calculation pool lets 10Q balance sheet and income statement apply the exact formula I did, and it's 7%. It's not great. I don't think the debt's going to be a problem though. Still don't really know what to make of the tax burden though. But I don't think the debt's a huge issue. It's going to be lower on open as well, is it? Is it going to be 298? Which one of these is the real prices? I'm going to watch this. I am going to watch this. I want to see what it does on open. GTM needs to be dark blue. Watch it. I still don't understand what this is though. Why there's two prices. It's been quite an interesting one, hasn't it, actually? I mean, there's no insider purchases, which I don't like at all. Who owns it? Probably a lot of firms I'd never heard of as well. It's not the sort of thing a value investor would traditionally own, I don't think. 100% portfolio, 100% portfolio, 33%, 33%. Interesting. So there are a few people that are very invested in this. And these paid way above what the fucking price is currently. They've recently purchased more. Who are these people? 9 discretionary clients. 500 million. Okay. This is interesting, isn't it? This one. More interesting than when I first came to it. We've been doing this an hour already, fucking hell. I haven't even got to the bloody one that I wanted to get to because of this. What other questions have I got on it? What was EBIT? 75 cents. Some free cash flow is higher. Is that because of write downs then, was it? Is that what we're saying? They're added back in. Very interesting. I don't know. I'm going to leave this one up to you to make a decision on. I will watch it though. For sure. For sure. Let's see what anyone else is saying. Sell. There we go. That was in 14. Sales confusion is a major red flag. Sell to slowing growth amid much better alternatives. He's been very keen on this being a sell. Oh, it's a hold a couple of times last year. I mean, he was right, wasn't he? And every single time, I guess, looking at the stock price. What's he saying then? Face accelerating top line deterioration remains uncompetitive amid sector-wide AI disruption fears. AI has prompted IT leaders to scrutinize expensive tools like GTM, intensifying pressures from competitors such as LinkedIn and Salesforce. The company notes that many of its customers have been confused by AI's capabilities, which has led to seat churn and weaker sales cycles. Software sector still remains in deep bear market, agreed. All in all, I believe AI-driven reset of software sector is unlikely in many cases. However, there are companies that are unlikely to endure a shift, and ZoomInfo is one of them. The company continues to see deteriorating growth rates as evidenced in its Q1. Cut to full-year guidance could boot the market further, sending shares down 30% in after-hours trading. Well, it's lower than that now, isn't it? I'll tell you one thing I do want to know. Have they given free cash flow forecasts? Since then, Zoom has been a sharp erosion in its share price while the rest of the stock market has rebounded. No light in the tunnel here. The company is no longer remaining competitive in today's market. Professional grade software products offer critical third-party integrations and maintenance support, which cannot be easily replaced by DIY agentic AI solutions. Okay. Pricing is highly customized for each client and not publicly published, but third-party reviews note that the entry-level plans 3 seats, 15k. Plenty of competition. All LinkedIn. Loss of momentum in the marketplace is clearly evidenced by its growth struggles alongside its Q1 earnings print. ZoomInfo cut its career. Yeah, we just read that year on year. We know that most software companies have not cut their guidance this earnings cycle, with many actually achieved and beat and raised quarters. So ZoomInfo can't blame the macro alone. It's doomed to keep losing value. I mean, I don't know enough about this sector to make an opinion on it, but this guy sounds like he does. Management knows company sales face not just macro headwinds but also confused buying landscape. Companies also acknowledge specifically they expect pressure on seat counts going forward. While we exceeded our guidance in Q1 as macro conditions worsen at the end of the quarter, we experienced a regression in our down market and up market growth trajectories. Pause in purchasing decisions on our software. I mean, if they're getting rid of 20% of their staff, they're obviously acknowledging there's something going wrong, right? Okay. I mean, I feel like this is a buy at some price. It depends on what that price is, though. AI is a potential threat to sales momentum. The company is banking on the hopes that its data assets will drive value for customers going forward. As that collecting and maintaining this data is very tricky. They said we think AI can also be applied to this data maintenance and eroded ZoomInfo's proprietary data moat. Net revenue retention in the quarter clocked in at just 90%, indicating a high 10% churn rate. The company is responding by reducing headcount and eliminating down market sales resources. For now, the company knows that its adjusted operating margin still rose 2%. That said, we know the company is a large add back for stock comp. Yep, don't like that. At 25 million in the quarter, stock comp is 8% of revenue. On an annualized basis, 100 million stock based comp represents 6%. I said that, didn't I? Don't like the stock comp. This is likely to raise eyebrows in more conservative stock market. It's paying far more attention to dilution, churn, and revenue. Okay, current shares near 4. ZoomInfo trades at a market cap of 1.3 billion. When we look tack on 1.3 billion debt, net off. Company result net enterprise value is 2.44 billion. That was back then. Against the midpoints of ZoomInfo has reduced guidance stock trades at 2.16 times unlevered free cash flow. However, ZoomInfo's cheapness, the company has no catalyst to drive an upward re-rating. Its continued slippage in growth provides steer clear here and invest elsewhere. Comments. Inexpensive right now by 2.4 forward earnings expectation generated. This stock is oversold. That was 2 days ago. Thanks to the write-up, I was super interested when I thought their data might be worth something. Spoke to a few peers who are still using this at their company. However, when you realise LinkedIn technically has the most data along with Apollo and Clay, you really start to doubt or wonder how much their data is actually worth. I don't think it's fucking worth anything. I mean, it is, I guess, but that's an intangible, isn't it? This is now bargain stock ripe to be acquired. Definitely time to snap up shares. Should be an easy double inside of 12 months. CEO won't support it. They gave him a monster compensation package for the stock. Has to hit like $30 a share to go in the money. Then he's a billionaire. It's a very deep hole to dig out before he joins the billionaires club. Not 30 or close. CEO doesn't individually decide to accept an acquisition or not. The board does. That's granted a one-time premium price performance stock-based comp. Right. The stock has to be more than $40 for the award to create generational wealth. Is this thing? Oh yeah. Great call on the earlier sale. It certainly seems like AI can make this one obsolete. Would you like them to say we suck and we have no idea what we're doing? What public company? There's a few people that bit of an argument going on here. That value kitty. Who's this guy? Just someone ripping off the name, I take it. Member since 2020. Anyway. No, it's not possible to build yourself a There's some arguments going on there, and some people think it's cheap, others don't. Price of publication $4. I'm gonna keep an eye on it. If it keeps going cheaper, then it could be worth something. You know, 300 million in cash, and it's they got an EV of 2.27 billion. So why is mine only $1 billion? F60 enterprise value 59 plus balance sheet 9, cash and short-term investments B28 and B34. Hang on then, is my data right or is it wrong? 28 short-term debt, 34 long-term debt. What's wrong there then? Something's not right. Is it long-term debt's wrong? Long-term debt's significantly wrong here. So the enterprise value, there we go, 1.76. Why is long-term debt so-called dropped off? It hasn't, has it? We know it hasn't. What was they saying it is? 240. Let's look at the wrong thing. Here we go. Look, everything is just about to change. Everything is just about to change. Long-term debt 240.8 says used operating lease liability instead of this 1317200. Watch this. Debt's come down mine significantly, but 1317200 123 boom. Now is that right? 1317200. Yep. 1317200. Now let's look. 2.1 billion. All of a sudden it's 6-7 times, which ain't that cheap. Should have noticed that earlier, shouldn't I? Check your data, people. Check your data. Yeah, check your data. It's the moral of that story. We're going over an hour. We've got this one to go as well before I even get down to that. Engage in provision of cloud-based on-premise software solutions. Again, software. Just run this quickly through here. BLBK. Was it BK or KB? Blackbaud. 300 million enterprise value. So no. Return on capital is very good though. 70%. EV free cash flow 8 times. I would say I'm not interested. Is this the AI driven route? I mean, it's literally at a, what are we at? 12-year low. AI fears. AI innovation, resilient contract growth drive strong free cash flow and buybacks. May 19th. In line. That was April. It's gone down since then. Gone down almost 25% since then. Revenue growth, strong AI adoption, still going down. Strong growth in revenue, still going down. Let's ask a new question, just quickly. BLKB. What was it? Blackbaud. Keeps showing growth and strong indications, yet stock price keeps falling. Why? I bet it's because it's AI. Solid operational growth and profitability improving share stocks plummeted roughly 55%. Disconnects comparable at market valuation multiple sentiment, broader sector trends, balance sheet factors often outweigh recurring revenue growth. It's highly recurring. Profitability margins expanding. Share buybacks aggressive. Millions of shares in Q1 signaling management confidence, high free cash flow yield. Analysts generally see it as undervalued on metrics like forward PE with average price targets. Okay, high debt load and interest expense. Okay, carries substantial debt. Let's have a look. Didn't even check that. Total debt 1.1 billion. Cash short-term investments only 41. I haven't got interest expense on it either. I've not in this. Gap revenue declines in divestiture. Oh, I gotta put the fucking share count in, and so we can see what's done long term. Earlier high valuations were compressed as analysts cut prices. Software stocks have faced pressure. Momentum is weak. AI, that's why. Strong indications haven't translated to re-rating stock higher yet. Markets pricing expectations and risk more than current results. Bottom line appears fundamentally stable with durable moat in its niche, strong cash generation, self-help. Stock fall largely reflects multiple compression from higher interest costs, macro worries about non-profits and risk of sentiment in software rather than operational failure. If it executes on AI, maintains organic growth and reduces leverage, it could re-rate higher given the low valuation. However, near-term volatility is likely tied to macro data. Okay, we're not going to look into this one, we'll move on. And maybe, look, we're fucking an hour and 12 minutes in. Do we look at the other one next time? Where are we? Where are we? Here. It's quite high already, that, isn't it? What was it on the quick take? Was it CRDA? Is that it? Very nice. Return on capital all the way through. Simple free cash flow of 100 million. Enterprise value, so 7 times. 7 times. Do I look into it or not based on that? Or do I just go away quickly and do this share count thing properly in the thing? You know what? I think I'm going to end it there and probably not look into this. Do they do dividends? They do dividends. What do they do? 7. So 15. What are they, 30-cent dividends? Around about 30 cents in a year. So 0.3 divided by 10.9. 2.7%. That's not great, is it? Decent floor here, technically, though. Very decent floor. Maybe we'll put some alerts down around here. Problem is, the trading view alerts don't last long enough, man. I want alerts that could last years, and these don't. I think my broker ones last, so maybe I'll have to start putting some alerts into the brokerage. Did that alert even go on? That went on. Edit alert on rectangle, yeah, it did. Right, okay. Spent a lot on one stock tonight, really, not doing the whole saying no fast thing justice, but it was quite an interesting one in the end. It turned out to be quite interesting, I think. Definitely one to keep an eye on, even though they're not buying, which is a bit of a red flag to me, to be honest. Ripe for acquisition, someone said, but I had one of those once that I looked at on one of my videos and I was umming and ahhing over it. Didn't see too much value when someone commented saying it was ripe for acquisition, and fair play to them because they own the stock, and the stock, I believe the price went up based on the potential for it to become an acquisition, so fair play. It was probably the first time that it taught me to maybe look at the potential for an acquisition. How many customers do these have? Does it say? Surely they published that. Come on. 35,000 customers. How does this compare to peers? What is the peer analysis as well? You can get it on here, can't you? Peers. ZoomInfo, ZipRecruiter, Pinterest, Snap. No, they're not real peers. Especially not the ones that the geezer that seem to appear to know what he was doing we're talking about. Pardon me. Any news on it? Got hiccups that come out of nowhere. I was just saying bye as well, one I now we're going back into it. News. Claude now enabled by ZoomInfo's GTM context graph. What does that mean? I know what Claude is, but the all-in-one AI has made its verified go-to-market data available inside Claude, Anthropic's frontier. Okay. Connect their entitlement to Claude through a native connector list in Claude AI connector directory. Once connected, a user asking Claude about a company contact gets verified ZoomInfo data inside the response. Okay. 600,000. Wow, so they are small. They are small. Not small as these guys, or these guys, but much smaller than these. Compare EV to free cash flow multiples. Let's have a look. .5. Yeah, I said it's about 6, didn't I? Peer multiples. Okay, so they are lower. They are lower. Keep an eye on it. Maybe it'll turn into a buy if things get really bad. 35,000 customers is not a huge. Doesn't seem very big. Doesn't sound very big. What are they doing in revenues? What are they doing in revenues? Again, $1 billion in revenues. So they're a reasonable company. I was listening to a Value Investor podcast actually, where the lady that ran the hedge fund, I can't remember which one it was, but she was saying she doesn't use market cap or enterprise value. Well, not enterprise value, but she doesn't use market, because a lot of people look at market cap and say, oh, I use that for the size of a business. I know how big a business is because of its market cap. And she was like saying, no, you need to do it on revenues, not market cap, because market cap is like subjective, revenue is fact. So yeah, anyway, interesting. All right, I'm going to leave it there because it's midnight. Thank you for watching. Please like and subscribe, and I will see you on the next one. Thank you. Good night.